Iron Financial, the only place you need to forge a stronger portfolio and really cut through all the market weakness. I'm Alex, your lead analyst. Today, we are putting Canadian National Railway, ticker CNI, right under the microscope. Their latest earnings report just dropped. And you know, on the surface, the numbers look pretty solid. But we're not here for surface-level analysis, are we? We're here to stress test this company. Is CNI a true financial fortress built on a rock-solid foundation of operational excellence? Or is it just a facade, something that looks good from a distance but starts showing some serious cracks when you get up close? Let's dive in and find out. Look, before we even think about getting into the weeds on revenue and margins, we have to start right here. This quote sets the entire tone for everything we're about to discuss. Hold on a second, Alex. I think you're actually understating it. This quote from the CEO, Tracy Robinson, should be a massive flashing red light for everyone. This isn't some analyst speculating from the sidelines. This is the CEO, the person at the helm, admitting a fundamental failure right out of the gate. They misread the map entirely, they couldn't predict the volume environment, and that huge miss is hitting their bottom line hard. For me, this immediately frames the entire conversation. We're not just looking at a company that's navigating a few headwinds, we're looking at a fortress that's already under siege, and the general just admitted to everyone that they didn't even see the attack coming. So the real question is the rest of this report just damage control?
That's the central question, David, and believe me, we are going to answer it. So here's our roadmap for this deep dive. We are going to start with that very sobering admission from the CEO and what it really truly means for the business. Then, we'll break down management's three-point plan to defend the company, their battle strategy, if you will. After that, we put the numbers to the test, stress testing the financials to see if that foundation is as solid as they claim. We'll take a look inside the engine room at their operational efficiency before we methodically search for the cracks in the armor, all those structural risks facing this business. And finally, we'll deliver our iron financial verdict. Is it a fortress or is it a facade? All right, let's get to work.
Okay, so let's really unpack the gravity of this admission. The CEO is on the record pointing to what she calls a markedly worse macro environment. She's not just talking in generalities, they're talking about the specific, painful impact of unanticipated shocks. Think about things like tariffs and these ongoing labor issues, which, and this is their claim, have hit CN harder than other railroads. This isn't just a slight miss on a forecast, folks. This is a direct acknowledgement that the economic siege is real, it's here, and it's having a material negative impact on their ability to deliver on the promises they made to shareholders.
And this, Alex, is precisely where my skepticism really kicks into high gear. So management's response to this massive, admitted forecasting failure is to just come out and say that forecasting is difficult? Seriously? They're now going to provide guidance in ranges instead of specific point forecasts. So Alex, what is this really? Is this some newfound humility on their part, or is it a quiet admission that they've completely lost visibility into their own business? Because to me, it sounds an awful lot like they're preparing investors for persistent uncertainty and a whole lot of volatility ahead. You know, it's one thing to navigate a storm, it's a completely different thing to admit you can't even predict the weather anymore. That is a huge red flag for me.
That's a very fair point, David, and it really highlights the uncertainty we're dealing with. So they've acknowledged the siege is happening. The big question now is, what are they actually doing about it? Let's move on to how management is actively trying to reinforce the walls of this fortress. They've laid out a very clear, very deliberate three-point defense plan. This is their strategy to fight back against those powerful external economic pressures and, they hope, prove that the fortress is still standing strong. This is where we see if their actions can actually back up their words.
And here it is. This is their battle plan. It's built on three very distinct pillars, and you can see them right here. First, they're cutting capital spending, CapEx, to preserve cash and protect their free cash flow. That's a classic defensive move. Second, they're doubling down on productivity and cost controls. They're trying to get leaner and meaner right across the entire organization. And third, they're focusing on enhancing shareholder value, and they're doing that primarily through some very aggressive share buybacks. On paper, David, this is a classic defensive playbook for a mature industrial company facing a tough environment. It looks decisive, it looks clear. Now let's dig into the specifics of each of these points.
Okay, this first pillar is a big one. They are slashing their 2026 capital program by a massive $500 million. Let that sink in. Their spending is dropping from an expected $3.3 billion in 2025 all the way down to $2.8 billion. Now, management's justification for this is that their major capacity expansion projects are now complete. They claim the network and their fleets are now, and I'm quoting here, properly sized for this volume environment. This is a significant move to protect the balance sheet and bolster their ability to generate free cash flow.
The second pillar is all about operational muscle and internal discipline.
They're targeting a $75 million reduction, and this is specifically from management labor costs. So this isn't just about the typical furloughing of train crews when volumes get soft. This is a structural change. They're trimming the fat at the management level to drive long-term sustainable efficiency. They're making it crystal clear that cost discipline is a top priority, and they're starting from the inside out.
And the third pillar? Well, this one is all about the shareholders. In 2025 alone, CN went out and repurchased approximately 15 million of their own shares for a staggering $2 billion. They specifically accelerated their buyback program in the third quarter, and they explicitly stated it was the right thing to do given the attractiveness of our share price. What this is management sending a very clear, very loud signal to the market. We believe our stock is fundamentally undervalued, and we are putting our money where our mouth is to return that excess capital directly to you, the owners of the company.
Okay, but we have to challenge this narrative, Alex. We just have to. You see a decisive battle plan. You know what I see? I see a company battening down the hatches because they see a long, cold winter coming, slashing CapEx by $500 million. Is that really just discipline? Or is it a quiet admission that they see absolutely zero growth opportunities on the horizon worth investing in? Think about it. By preserving all this cash today, are they sacrificing the future capacity they'll desperately need when, or maybe I should say if, the economy finally turns around? It protects the fortress now, sure, but it might leave it completely unprepared for the next war.
That's the billion-dollar question, isn't it, David? It's that classic trade-off between short-term stability and long-term growth. We've heard the story from management, and we've certainly heard your skeptical take. So let's move on to the hard numbers and see if the foundation of this company can actually bear the load of this weak environment. We're going straight to the income statement to stress test the core of this company. This is where the truth lies, far away from all the narrative and the storytelling.
All right, let's look at the full year 2025 earnings per share. On a GAAP basis, that's the officially reported number, they delivered $7.57. That's a respectable 8% increase year over year. Not bad at all. But now look at the adjusted number, $7.63, a 7% increase. Management really wants you to focus on this adjusted number. Their argument is that if you strip out certain one-time costs, you see an even stronger, more profitable core business underneath. And frankly, delivering 7 to 8% EPS growth in this kind of economic environment is nothing to sneeze at. It suggests the fortress is, at its core, highly profitable.
But hold on a minute, Alex. Let's not just glance past these so-called adjustments. What are they really? We're talking about $34 million for employee termination benefits and severance costs from a workforce reduction program. Okay, and then there's another $15 million in advisory costs related to potential mergers and acquisitions in the industry. The bull case, your case, says these are just one-offs, noise in the data that we should ignore. But the bear case, my case, asks a very different question. In a constantly shifting macro environment, are workforce reductions and strategic advisory costs ever truly one-time events, or are they just the ongoing costs of doing business in a tough, consolidating sector? I think investors should be very, very wary of just ignoring nearly $50 million in very real expenses.
Now, let's look at the revenue breakdown by commodity, because this really tells the story of two different businesses operating under one roof. Just look at the strength in intermodal, up a very strong 10% year over year in Q4. Grain and fertilizers, another core business for them, is up a solid 6%. This shows real resilience in key areas that are less tied to the industrial cycle. Resilience in some areas maybe, Alex, but look at the segments that are tied directly to the industrial economy. Metals and minerals, down 5%. And look at forest products, hammer down 8%. And remember, management is on record warning about the continued impact of tariffs here. This brilliantly illustrates the macro headwinds the CEO was talking about. So the fortress might be strong in some wings, but it is clearly crumbling in others.
That's a fair point, David. The commodity mix definitely tells a mixed story. But enough about revenue for a moment. Let's get into the engine room. For a railroad, operational metrics are absolutely everything. This is where you separate the truly great operators from the rest of the pack. The bull case for CNI really hinges on this one core idea, that no matter what the economic weather is like, they run a tighter, more efficient ship than anyone else out there. So let's see if the numbers actually back up that claim.
And this right here is the slide that the bulls are going to point to all day long, the operating ratio. It's the key measure of a railroad's efficiency, calculated as operating expenses as a percentage of revenue. And in the fourth quarter, CNI improved its OR by 140 basis points, taking it from 62.6% all the way down to 61.2%. And remember, lower is better. This is hard, quantifiable evidence of disciplined execution and superior cost control in a very tough quarter. As the CEO herself stated, our operating ratio has been more resilient than most. We've been the first or second operating ratio in the industry for the past 3 years. This right here is the cornerstone of the fortress argument.
But Alex, let's add some critical context here because context is everything. Yes, the Q4 operating metrics, on their own, look fantastic. Revenue ton miles, or RTMs, were up 4%. Car velocity was up 2%. That's great. But now look at the full year picture. For all of 2025, RTMs were up only 1%, and car velocity actually decreased by 1%. So the crucial question that every investor has to ask is this: was Q4 some heroic turnaround that signals a new era of efficiency, or was it just a temporary blip, maybe an easy comparison to a particularly weak Q4 last year? The fortress looks great if you only look at the last 3 months, but the full year picture suggests stagnation. Is this strength really sustainable? I have my doubts.
That's the key question, isn't it? Sustainability. So now we move on to the part of the analysis where we actively go looking for the stress fractures. A fortress, after all, is only as strong as its weakest point. The bull case that Alex laid out focuses on that operational efficiency and the shareholder returns. But what about the structural risks? What are the cracks in the armor that could bring this whole thing down? Let's methodically outline them, and we're going to pull these risks directly from management's own commentary on their earnings call.
And this brilliantly illustrates the array of headwinds that they're sailing directly into. These aren't abstract threats. They are concrete, quantifiable risks that management themselves put on the table. First, safety. Year-to-date injury and accident ratios are up 4% and a very concerning 14% respectively. That's not a good look for a company that prides itself on execution. Second, the 2026 outlook is dismal. They expect flattish volume growth. Let me repeat that: 0 growth. Third, the tariff impact is getting worse, with forest products getting hit by another 10% duty. Fourth, the macro headwinds persist. Weak industrial production and housing starts are not going away. And finally, a very specific pricing issue. The regulated price increase they can charge for grain is collapsing, from nearly 6% last year to just 1.7% this crop year. Each one of these is a crack in the foundation. Together, they represent a serious multi-front threat to this company.
Let's bring this back to the overall financial health, though. Because despite all those risks you just laid out, David, from a pure profitability standpoint, the margins are excellent. An operating margin of nearly 38% and a net margin of almost 27%. This company makes a lot of money on every dollar of revenue that comes in the door. That's the sign of a fortress that can withstand some pressure. But I'll draw your attention to the other side of the balance sheet, Alex. The debt-to-EBITDA ratio is 2.51x. Now, they say that's their target, but it's still a significant amount of leverage for a cyclical business like this. But what's more concerning for me is the Altman Z-score, which is a classic measure of a company's likelihood of going into bankruptcy. At 2.5, CNI is in what's called the gray area. That score doesn't exactly scream impenetrable fortress to me. It suggests there's some underlying financial stress here that investors need to watch very, very carefully.
Okay, we've laid out all the evidence. We've examined the CEO's admission. We've analyzed their defensive strategy, we've dug into the core financials, the operational metrics, and, as David just detailed, the significant risks. It's time to bring it all together and deliver the iron financial verdict. We're weighing the strengths of this operational fortress against the sheer severity of the economic siege it's facing. So, David, let's get down to it. Is this company built of stone, or is it just a fancy-looking facade?
So the crucial point is this: the bull case, the whole fortress argument, is compelling. You can't deny it. You have a best-in-class operating ratio, which proves elite operational discipline. You have a management team making decisive cuts to costs and CapEx to protect the balance sheet, and they're returning billions to shareholders through buybacks, showing confidence in their own stock. But the bear case, the facade argument, is just as strong, if not stronger. The 2026 guidance is for 0 volume growth. That is a huge problem. Safety metrics are getting worse, not better. The macro and tariff headwinds are real, and they are intensifying. And most importantly, you have to go right back to where we started. The CEO herself admitted to a major forecasting failure. It just paints a picture of a company that, while operationally sound, is facing an external environment it can't control, and more worryingly, didn't even see coming.
And that leaves us with one final, provocative question for you to consider. Canadian National has proven, beyond a doubt, that it has an incredibly efficient engine. They can control costs and run their railroad better than almost anyone in the entire industry. But can that efficient engine perform the heavy lifting required to grow shareholder value if there's no fuel, no volume growth coming from the broader economy? That is the core conflict at the heart of CNI today. It's a battle between internal efficiency and external stagnation. And whether this company proves to be a fortress or a facade will depend entirely on which of those two powerful forces wins out. That's the question you have to answer before you invest. Thanks for joining us on Iron Financial.